China's housing market crash will be far worse than you think. China, which is run by communists, is currently experiencing an economic slump, while the country is currently maneuvering through a period of high unemployment and low growth, and as a result of collapsing property values and lockdowns imposed by COVID-19. While China is worse than you think it is. You want to know what all is happening? Well, you know it's all right here on Finance Basics, so let's dive into our video. This became abundantly clear in July of this year when the International Monetary Fund, the IMF, referred to the country's economic position as a worse than anticipated slump. According to what was stated in the report, in China, more lockdowns and the worsening real estate crisis have resulted in growth being revised down by 1.1 percentage points, with huge worldwide spillovers. The projections made by the International Financial Institution for the year 2022 indicate that the real GDP will expand by only 3.3%. According to reports, this represents the point in time when China's economic output changed at its slowest rate in the preceding 40 years, except 2020. The rate of unemployment in Chinese cities has reportedly reached an all-time high of 20%, which was reported by economist Raymond Young. The housing market has taken a significant impact as a result of consumers placing a greater emphasis on the importance of vital goods and services. The drought, the harsh heat, the energy shortage, and the country's zero-COVID policy have all contributed to making the situation even worse. Investment banks Nomura and Goldman Sachs reduced their previous projections for China's GDP on August 20th, bringing them down to 2.8% and 3% respectively from 3.3%. China's housing market has collapsed, and the fall in the value of real estate in China has been accompanied by a concurrent drop in the country's production of cement and steel. An expert on climate change named Laurie Mailavirda remarked on the topic when she was discussing it with The Guardian. Steel was recovering, but it's now plunging again, which shows the acute pain in the real estate sector. There are more than 50 million empty residences in China at the moment, according to recent figures. The housing crisis has been made worse by the fact that many housing developments are still unfinished, and mortgage holders are unable to make payments to the developers. S&P Global Ratings estimates that approximately 40% of developers operating in China are experiencing severe financial difficulties. The most recent example of this, which involves Evergrande skipping a payment on its debt totaling $300 billion, demonstrates the predicament. When real estate accounts for 70% of the average household's wealth, as it does in this country, this should be a cause for alarm. Michael Pettis, a finance professor at Peking University, emphasized the fact that China's property downturn is the culmination of 30 years of unrestrained rising property prices. Property developers had previously relied on soaring home prices and surging sales to justify large amounts of leverage and overbuilding. In recent years, however, this strategy has backfired. However, once the bubble started to fall a year ago, these over-leveraged property developers ran into a major liquidity and credit constraints that made it hard for them to finish their development projects, as he explained. Pettis observed that real estate developers have not yet delivered 40% of the apartments they sold in advance between the years 2013 and 2020. The finance professor has forecasted that China will have a protracted period of low growth, but he ruled out the possibility of a severe economic downturn. The Chinese government has chosen to decrease interest rates and sell additional bonds to stimulate economic growth and consumer spending. Pettis thinks that it will not produce results, and households will avoid placing additional pressure on themselves by taking in additional debt. Inflating loan numbers is being done by banks. China is putting pressure on its banks to lend money to its citizens and increase the flow of credit into its economy. According to Bloomberg's research, the forceful move has caused Chinese banks to artificially increase their loan levels. One of the strategies consisted in approving loans for businesses and then requesting that the businesses deposit the money in the bank at the same interest rate as the loan. Another strategy that was utilized by the state-owned banks was the provision of short-term financing to one another. This was then shown in the record books as a new loan. This information was anonymously provided to a trustworthy source by officials working at 6 different banks who corroborated it. Because consumer demand is at its lowest level since 2007 and uncertainty is at its highest level, initiatives to enhance credit or drive loan growth have not been successful. This is made abundantly clear by examining the situation of a reputable electronics company located in Zhejiang. Bloomberg reports that several financial institutions have expressed interest in providing the company with financing at exceptionally competitive interest rates. In spite of this, the company decided not to take out any loans. We're not going to borrow money because we have enough cash on hand to completely support our operations as well as our small growth. Both the COVID outbreaks and the collapse in the property market have affected us, stated Albert, the CEO of the company. According to Bloomberg, state-owned banks are also hesitant to lend money to smaller enterprises since they do not have sufficient collateral or good credit histories. One manufacturer of electric car components in Anhui disclosed to the news organization that the company was only approved 60% of the loans it applied for due to its limited capacity to repay the loans. In addition to the pressure that is already being placed on the Chinese banks as a result of the slowdown in economic activity, comes the additional danger of loans that are not being repaid. If borrowers keep up their threats of a boycott, financial institutions might be on the hook for mortgage losses totaling $356 billion. This is because the real estate industry accounts for approximately 30% of all loans. As a consequence of this, financial institutions are being forced to choose between satisfying the excessive demands of the Chinese government on the one hand and the difficulties associated with risk management on the other. According to a comment made by an official at the CBIRC named Liu Zhongri, the pressure on non-performing loans to rebound increased as the downward pressure on the economy is gradually felt by the financial sector. With the continuing rise of China's jobless rate, China is currently dealing with a crisis of unemployment in the middle of an economic slump. The country's Ministry of Human Resources and Social Security said that the country's jobless outlays grew to $5.45 billion in June of this year. This sum is 3,600 times greater than the monthly compensation that the unemployment insurance program in China will provide for June of 2021. In addition, there was a 20% increase in the number of people receiving benefits, which resulted in a shortfall of 22.7 billion yuan. According to reports, this is the largest deficit that's been reported by the insurance system since March 2020, when it registered a loss of 15.6 billion yuan. Peter Hannum, the economics writer for The Guardian, estimates that approximately 1 in every 5 people in Chinese cities between the ages of 16 and 24 is actively seeking employment. The level of competition for available employment has increased to a point where it's more difficult to succeed. The Chinese government is providing financial incentives to businesses in China that maintain their staffing levels. It is now possible for large firms to receive a reimbursement of up to half of their unemployment insurance contribution from the previous year. The same has been raised to a level of 90% for both small and medium-sized businesses. It's interesting to note that the fund for unemployment insurance has been on a downward trend since 2019, when the trade war between China and the United States began. In an interview with Nikkei Asia, economist Takamoto Suzuki stated, "There's a good likelihood that the unemployment insurance system would wind up running a deficit for the full year in 2022. In conclusion, he said, if the fund balance continues to fall, it will become more difficult to engage in incentives and initiatives that residents will embrace, such as expanding eligibility for payments or extending the duration of insurance benefits." While our attention is currently focused on the economies of Sri Lanka and Bangladesh, likely a slowdown in China's economy and the repercussions of that slowdown will be what dominates headlines across Asia and the rest of the world in the coming months. We'll be back with some more information, but in the meantime, we'd appreciate it if you would like this video and subscribe to our channel. And thanks for watching.